Hello ladies and gentlemen, welcome to the channel. Tonight we're going to discuss about the moving averages. There are two types of moving averages, SMA and the EMA. We are basically going to talk about the EMAs. I actually don't use SMA. EMAs are fine with me. And as we know that every indicator is delayed, so it's better to have less delayed one. SMA is actually very much delayed, okay. So before we go into talking about the moving averages, you should actually know about levels. So let's have a conversation about price. When the price moves higher, it cannot just go in a single move. Or if the price is dropping, it cannot just drop in a single go. It cannot just go from $1 to $100 in single row, and from $100 to $0 in just a single row. It has to move in levels. In a way, I'm saying if it goes high, it has to retrace back, and then it has to continue higher if it has to move higher. And those things are called as levels. In a way, if I'm saying this, high, low, and then go higher. As the price move higher, it retraces back to the EMA, and then it continues to the going high. So and this retracement causes a box-like structure here, which is called a level. Now this is a level. It just won't be like price goes high, it comes lower. No. There would be a lot of consolidation within it, because that is the trap, right? That is a trap. And when we look at the trap inside the level, we understand that the price will actually go more higher, or the price will just straight up drop to the downside, right? So this is how we define level. Now let's talk about the moving averages here, okay? First things first. Here what we can see is the price moved higher, then it just consolidated in a range for a while, and this created a level here, then it bounced back fucking to the high side, and this created a level here. This is a level. This is what I'm talking about. Now, the retracement. What is retracement? Okay, retracement is like dropping of the price, or like rising of the price in the opposite direction of the movement, and then continuing to the correct direction as it was going before. Okay, and if we know that the price have to move higher, then it has to retrace first before going higher. So we can use EMAs as two types. First, to enter or to exit a trade. Okay, I use EMAs for two things: entry and exit. So this is how it works. If the price moves higher, we know that the market maker is selling and we are buying at the same time, and a retrace has to come, even if it has to move higher. So when you see a stopping volume like this, or an inverted hammer, in a way we can say that we expect a retrace. So we go short till the next EMA of 13 or 50, because we know that those are the EMAs until where we can see the retrace on a lower level. On 1 hour, 15 minutes, or 5 minutes, we see retraces to 13 or to the 50 EMA. If we go on the bigger time frame, we actually see it on a bigger time frame as well, on a bigger EMAs as well. But retracement has to happen. Retracement is very important. Okay, so retracement happens to the EMA. So we can say that if we see this kind of a behavior, we can enter here and we can exit here. So that's why we use EMAs as an entry and exit point. Now we use the EMA as an exit point here. And also, okay, come on. We know as the price moved higher, it retraces back to the EMA. It consolidation. Within the candles, we have the confluence that it has to go more higher, because this is not the range. People are not getting induced that much, right? That's why he has to move the price more higher. So as soon as we exit here, we can re-enter at the same point again, and then go long, and then wait for the highest price possible to hit the 800 EMA, and again exit at the 800 EMA. It didn't actually hit here, it hit it here, so we will exit it here, or you can exit manually as it goes close to the 800 EMA. That's how we use EMAs as for entry and exit, and this is the concept of retrace. Even if it price has to move higher, or if the price has to drop to the downside till hell, it has to retrace, and it has to retrace, and then it has to bounce back from the EMA. Look what has happened here. We know the story of this drawing. We have discussed it many times, but I'll say it again. Market maker was selling, we were buying. The price was rising high. We created a level here, kind of a consolidation, lots of accumulation of traders, but people were not still investing. So market maker pushed the price higher again, and then he started to trap more and more liquidity to the upside. And as he was done with the intention, he just made a stop on rise, drop to the market, finishing everyone else. And if you look at the 4 hours time frame, the same behavior It actually dropped back to the 50 EMA and then it bounced back higher. Didn't happen perfectly, but it's fine because we know he had to go here. He had started his intention in this region, so he had to go there to close his order on the zero loss. We know this is the concept of level, support and resistance. This is why the levels become, right? We know he started the intention here, so he had to go there. So he crossed the EMA and went there and fucking pulled it back to the EMA. This was a pullback. Seen this? That's why EMAs can be used as an entry and exit, as a point for either stopping the price action or actually rebouncing it. I wish you're understanding what I'm saying this. But there will be more videos on EMAs as well, because EMAs is a very fucking important thing. There are lots of things that we have to actually discuss. All right. And then there is also two new concepts that if they're okay. Let's revise a little bit. What did we discuss at if the price have to go higher, it has to actually retrace first before going higher. And then it can continue higher. You know what this is called as? This thing is called as a mean reversion. Market makers use this. This is called the mean reversion. It reverts to the mean and then continue higher again. And the EMAs will go higher with you. Then they will have a pattern formation or some shit here. And then the EMAs will be following it and the EMAs will turn over. This is called the mean reversion. Okay. The retracing back to the EMA is called the mean reversion. Now, here. We were discussing about the expansion and contraction of EMAs. As soon as the price explodes to the upside, EMAs expand. And if an EMA is expanded, he has to contract because of the mean reversion concept. Do you understand? It has to contract to like consolidate the price, to stabilize. That's what the concept is. It has to expand, it has to contract. And you can even trade on the EMAs. As soon as you see it's reversing, it's turning the direction, and there is a red vector candle crossing the 50 EMA, this confirmation trade. This is the confirmed trade to the downside. So you go short here. You ride the move to the 200 EMA. That's it. That's how it is. This is expansion, this is contraction. And you can see it a million of times happening. Look at this, my guys. There's again an expansion. There was no contraction. Then we see a rejection here. It started to contract, but look at what has happened. It has not contracted yet. It's just moving straight. And after it contracted, there was a cross here, and again expanded, and it has to contract again because of the mean reversion concept. The price has to mean reverse. Even if it has to move in the same direction, it has to mean reverse. So that's it for the moving average videos. We learned that we can use moving averages for entry and exit. We can use it for retracement levels and for understanding the confluences between the levels. Also, we need a deeper understanding of the candlestick to understand what actually is happening in the level, so we can decide it will work as a continuation pattern or it will reverse to the downside. Now, at the end, we learned about expansion and contraction of EMAs, which is fucking important. If you don't understand it, please repeat and watch it again because it's fucking important. The price explodes to the upside, the EMAs expand, and then it starts consolidation. The EMA starts getting stabilized, and as soon as the EMA gets stabilized, it retraces back and crosses the EMA fucking faster, and then retraces back to the EMA and then fucking drops the market to the downside. This is how it is. If I show you the drawing, price action explodes to the upside, starts consolidation. The EMA here fucking starts exploding to the upside and then starts contracting because it's a delayed indicator. Then the price action actually fucking crosses the EMA, reaches back to the EMA and fucking drops to the downside. What has happened here? Now it expands from this side. Do you see what happened? These are the EMA, 513 EMAs. This is how they expand. This is how they cross. Then again they expand. And then again it will stabilize, and then again it will cross. This is how the business happens, expansion and contraction. You can trade over that. You cannot wait for the dead cross because sometimes dead cross is already late. You have to trade on the turnover and the candlestick prediction. What is the price action telling you, okay? You have to trade on that rather than trading on the crosses. Come on. If you trade on the crosses here, this is where the cross happened. If you check, This is the next candle. After this candle, the cross was confirmed. So you would have been short here. You would have righted just this much move. But instead, if you would have righted the turnover of the price action, which was here, and there are some more concepts which will make you learn why did the turnover happen, and you would have actually went short here only, straight up, not gonna lie, but just looking at the EMAs and as well. But yeah, for more confirmation, you would have done here after crossing the EMA so slaughtery, and even if it retraces back, come on, look at the spike. It actually retraces back to the 5 EMA and then dropped the downside again. It works so perfectly, come on. If we zoom on it, come on, look at this, how perfect it is. It drops to the downside, it reaches back to the 5 EMA, and fucking drops. The values of the EMA which I'm using is 5, 13, 50, 200, and 800. That's it for today's video. In the end, I'll just say check out the description for our website. Join our private masterclass, as we are going to guide you through the projections, through the guiding streams, and everything. Masterclass session. This is how the website looks like. And for our YouTube gang, lots of free videos and learning streams are coming up. Just subscribe to the channel, hit the bell icon, stay tuned. Mad level respect for passing by the channel. Peace and have a nice day.